This hearing is back in session. I want to welcome Mr. Gallant, the Managing Director of Property and Casualty Insurance of Keefe, Bruyette and Woods. Mr. Gallant is an equity research analyst who covers the insurance industry, and he's here to share his thoughts on AIG's current financial outlook. We appreciate your being here today, and I'd like you to make opening remarks, if you would, and limit them to 5 minutes.
Okay. Thank you
for
the
Mr. Gallant.
opportunity. Yes, on April 27th, we published a report on AIG where we downgraded the shares to an underperform. We put a $6 price target on the stock, and at the time that was considered somewhat controversial. At the time, the stock was trading in the mid-40s, it's still in the low 30s. However, we didn't view our conclusion that there is not a lot of common equity value in the stock to be all that profound. In fact, we view it to be somewhat self-evident. And by that, I think there are two main realities of the company. One is that it's still dependent on government aid. And I think that the evidence of that is in the first quarter that there was further access of government credit lines. The FRBNY loan went from $23.4 billion to $28.9 billion through April. And the Series F U.S. Treasury yield securities went from $5.3 to $7.4 billion. Secondly, when we do any type of sum of the parts analysis or try to valuation of the company, it's hard to come up with a positive number. And I think that's a somewhat obvious reality of the current financial position of the company. I think that investors do need to understand a few key points. One, there is a great franchise beneath this company. The insurance operations have a fantastic global footprint. And I would say that the current management team has done a very good job with the company in terms of stabilizing it, stem the loss of people and of clients. And a lot of credit needs to go to them for dealing with what is obviously a difficult situation. That said, I think in terms of valuing the stock, there are some things that people have to be aware of. One, the book value is not a normal book value calculation, right? It's the debt to equity is something like 7 to 1. That's a ratio that no other insurance company is at and could not normally operate at. If the U.S. government were to be replaced with just normal private creditors, I don't think that they could conduct business. The only reason it does happen is because it is the U.S. government that is the backer. The earnings that the company is producing do not accrue to the common shareholder in the normal fashion because there is a preferred shareholder, preferred stockholder in the Series E stock. That dividend has not been paid. But if they financially get to the point where they can pay that, I assume that that's where the money's got to go. It can't accrue to the common shareholder. So again, you can't use a normal PE ratio here to value AIG. And there are a number of book value concerns with the company. I think if we were to have a public offering of the shares on a large scale, I think investors would want a discount to book value for several reasons. One, concerns over the quality of property casualty reserves, valuation of things like the ILFC aircraft leasing business. And I think one thing you need to keep in mind as well is that the peer group, the property casualty life insurance companies today in the market, several of them have redundant capital positions or buying back stock, have releasing reserves, and yet they're all trading below book value, something like 85, 90% of book. I got to assume that AIG would trade at a discount to those peers. And finally, I think just as the systemic risk fades, I think the treatment of AIG is likely to change. I believe that since September of 2008, as a result of systemic fears, the taxpayer has had to take some losses on AIG, has had to be very generous towards its treatment of AIG. Debt has been restructured, TARP debt was changed into this non-cumulative form, and those things, were necessary, needed to be done to keep the company going. But I have to believe, as that systemic risk fades, that it's less likely to happen. I think the taxpayer is going to say, cash expended needs to result in cash back into the shareholders' taxpayer's wallet. And during that process, I believe that the common stock will largely be, you're not going to find a lot of value left for the common shareholder. I think it all comes down to a question to me is when I talk to the bulls on the stock is that there's this view that, that there is value in the company, yet in the same breath there's this discussion of somehow the taxpayer taking some losses as the government tries to exit its position. And in my point of view, that if anything indicates that our initial assessment is right. I mean, if the taxpayer is expected to take a loss, how can there really be value here net in the company?
Very helpful. Thank you. So let me see if I can just disaggregate this a little bit
Sure.
and figure out what's going on. Do you have any assessment of whether or not AIG is likely to need more government assistance to meet its liquidity needs?
In their 10Q, they disclose debt that's coming due throughout this year. Even excluding ILFC and AGF, there's something like $10 billion due in 2010. Since AIG is not able to access normal debt markets, I have to believe that they will further draw down on government credit lines to make those payments.
Okay. Do you have any sense, just as you project this out, when the point might come that the government will not be called upon to continue its support for AIG? Before we get to the question of unwinding the interest that we already have.
Yeah. No, I mean that's a question I can't really answer. I think AIG FP's portfolio, as that winds down, that would seem to be at least one indication of less systemic risk being posed by AIG. I think that the insurance subsidiaries, as I know other panelists have discussed today, are probably financially stable and sound, and so that is probably not a reason to wait. It seems to me that the systemic risk seems to reside in the parent company.
So actually, let me ask it then a slightly different way. What are the conditions that need to be met? And we'll take them in all, that the government doesn't have to put more money in, and then we can talk about the second one about how the government starts unwinding its position. What do we need to see happen? We've got AIG has 2 sales pending, right? So I presume part of it would be the completion of those sales.
Right. Right. That's a big step, right? You start to see, again, cash back into the taxpayer's wallet. I think the ability for AIG to access debt markets in a normal fashion is a key.
It would be a very good sign when you can see AIG borrowing in the debt market.
That's right. That's right. Presumably with the expectation that they'll be able to internally generate the funds to repay that debt.
That's right.
I think those are the big things that we would expect to see over the next year.
Okay. I noted in your written testimony, you talk about that the current structure is unsustainable and that some sort of resolution must occur. Can you just elaborate a little bit on that?
Well, simply that
wasn't all the way to a blueprint.
Yeah, well, the government doesn't want to be a permanent investor in AIG. That's basically the bottom line for me. And I think if you're going to value the common stock, if you want to invest in this company, you have to assume that the government is going to get out. And so that's the approach we took in coming up with our price target.
Okay. It's very valuable. Thank you very much. Mr. McWaters?